ARM dropped 7.5%, and everyone is panicking. ARM9 is firmly mandatory in NVIDIA's Blackwell GB200 NVL72 rack-scale AI system, guaranteeing massive design wins. That architecture underpins every Blackwell deployment, locking in revenue for the next 3 years. But the lab score is 60 out of 100. Why? Here's why the sell-off is wrong. ARM sits as a Tier 1 bottleneck in the AI supply chain, the IP licensing layer, currently in a rising phase. ARM Holdings is the most expensive toll booth in the history of computing, and the market is checking the gate. While the broader indices like the QQQ, the NASDAQ 100 Exchange-Traded Fund, and the SOXX, the Philadelphia Semiconductor Index, are trading flat, ARM is hemorrhaging 7.45% to close at $298.23. This move is a violent collision between extreme valuation and the reality of a sector rotation. The lab is watching a 44.6% decline in trading volume below the 20-day average, which tells us the aggressive buyers who drove the 42% outperformance over the last month have suddenly vanished. The market is currently repricing the risk of a high-flying IP. Intellectual property, the legally protected chip designs, play that is trading at a massive premium to the rest of the semiconductor stack. We are seeing a classic consolidation phase where the price has dipped below the 20-day moving average of $357.77, testing the conviction of every investor who chased the AI narrative at the top. This isn't just a random Tuesday dip. It is the market questioning if the royalty growth from the new V9 architecture can actually outrun the gravity of a normalizing interest rate environment. The sentiment has shifted to fear, and with an RSI, Relative Strength Index, a momentum indicator where below 30 is considered oversold, now sitting at 27.6, the technicals are screaming that the rubber band has snapped. Capital is rotating out of pure-play licensing and back into companies with physical manufacturing tailwinds, leaving ARM to defend a $319 billion market cap that rests entirely on the speed of the global transition to its latest instruction set. The engineering reality of ARM's $319 billion valuation rests on one specific metric: the transition from ARM8 to ARM9 architecture. ARM9 is the ISA, instruction set architecture, the fundamental vocabulary that software uses to talk to hardware, that doubles the royalty rate per chip compared to its predecessor. The key differentiator is SVE2, Scalable Vector Extension 2, a hardware-level instruction set that allows the CPU to process massive data arrays in a single cycle. This is mandatory for on-device AI workloads. In early fiscal year 2025, ARM9 penetration reached approximately 25% of royalty revenue, but the market is pricing in a much faster ramp. We look at the Cobalt 100 and Google Axion CSS, compute subsystems, pre-integrated silicon building blocks, which are delivering 30% performance gains over traditional x86 server architectures from Intel and AMD. However, the physical bottleneck is the Qualcomm litigation over the NVIDIA Orion cores. Qualcomm is using a custom architectural license to build high-performance silicon that ARM claims violates their agreement. If Qualcomm wins, the royalty moat, the competitive advantage built on collecting a percentage of every chip sale, begins to leak. Furthermore, we are tracking the RISC-V, Reduced Instruction Set Computer 5, an open-source alternative to ARM, threat, which is at least 5 years away from server-grade maturity, but is already eroding ARM's dominance in low-power IoT. The engineering confirms that ARM has the superior power performance area profile, but the 96.8x forward PE, price-to-earnings ratio, a valuation metric comparing stock price to projected profits, assumes ARM9 will capture 100% of the mobile AI market without a single legal or competitive hiccup. The silicon is solid, but the royalty math is stretched to its physical limit. Quarterly financials showing modest revenue momentum for ARM. By the fourth quarter of 2026, the normalization of the yield curve, the graphical representation of interest rates across different maturities, will compress ARM's valuation multiple by at least 15% as capital flows toward companies with immediate physical manufacturing yields rather than long-term licensing royalties. The macro environment is no longer a tailwind. It is a friction force. With the Fed rate holding at 3.63% and the 10-year yield at 4.49%, the cost of capital is fundamentally repricing high-growth tech. ARM's beta, a measure of a stock's volatility relative to the overall market, of 3.77 means that for every 1% move in the S&P 500, ARM moves nearly 4%. In a market where the yield spread has normalized to plus 0.35%, the easy money that fueled ARM's 47.9% EPS growth is tightening. Prediction markets on Kalshare now place recession risk at 8.2%, a low but non-zero number that is beginning to weigh on the aggressive R&D, research and development budgets of ARM's primary customers. We are seeing a rotation where capital is concentrating in custom ASIC, application-specific integrated circuit, a chip designed for a single-purpose design, but ARM is caught in the middle. While TSMC's May revenue hit approximately $13 billion, up 30.1% year-over-year, that growth is being captured by the physical manufacturers, not necessarily the IP designers who are still waiting for the next royalty cycle to kick in. The Consumer Price Index at 0.6% year-over-year suggests inflation is cooling, but for a company like ARM that relies on high-margin licensing, any slowdown in global consumer electronics spending is a direct hit to the bottom line. The geopolitical reality for ARM is a minefield of export controls and regional instability. The U.S. Bureau of Industry and Security has implemented strict restrictions on high-performance compute, which directly limits ARM's ability to license its Neoverse V-Series cores, the high-performance designs used in data centers, to Chinese hyperscalers like Alibaba and Baidu. Historically, China has been a significant revenue driver for ARM, but the geopolitical friction is now threatening the royalty streams from the ARM-China joint venture. This isn't just a trade war, it is a structural decoupling. As domestic risk-free alternatives gain traction under state-led self-sufficiency mandates in Beijing, ARM's long-term moat in the region is being systematically dismantled. We are also tracking the risk of a trade war over Greenland and broader tariff uncertainty, which adds a layer of unpredictability to the global supply chain. If a 10% or 20% universal tariff is applied to semiconductor components, the bill of materials for every smartphone and server will spike, potentially slowing the adoption of the expensive ARM9-based chips that ARM needs to justify its valuation. Socially, the political backlash against big tech and the rising tide of AI regulation are creating a wait-and-see environment for enterprise software deployments. This creates a lag in the royalty compounding story. The lab sees the macro environment as a rising tide that is starting to ebb, while the engineering of the Neoverse V2 platform is superior for generative AI workloads. The geopolitical and monetary constraints are creating a ceiling. ARM is no longer just a tech story. It is a proxy for global trade stability, and that stability is under fire. The macro narrative is shifting from AI at all costs to AI at a sustainable cost. And with a forward P/E near 97x, ARM is the most expensive cost in the stack. The lab breaks down the macro link. Hyperscalers poured $129.8 billion in Q1 26 capex, $44.2 billion from AWS, $30.9 billion from Azure, $35.7 billion from Google Cloud, $19.0 billion from Meta. That spend drives procurement of ARM-based server silicon, which translates into royalty and licensing fees for ARM. With Q4 revenue at $1.49 billion, up 20% YOY, we see the direct contribution of that capex to our top line. We watch the pipeline from cloud spend to silicon design, and we stay focused on the growing royalty stream. ARM reported earnings per share of $0.60, beating the Wall Street estimate of $0.59 by 2.1%, a solid beat that signals strong execution. ARM posted 3 consecutive earnings beats after a single miss, delivering 60 cents EPS versus 59 cents consensus in Q1 2026, 43 cents versus 41 cents in Q4 2025, and 39 cents versus 34 cents in Q3 2025. Management kept guidance steady, raising price targets from $260 to $475 after the Q1 beat. Yet the stock slipped 7.5% to $298 on the day, indicating the market is discounting beats and rewarding guidance less aggressively. The pattern shows a brief beat streak, modest guidance upgrades, and a muted market reaction. ARM, IP licensing, is trading below its 20-day average at 200. Management's headline: any weakness we see in memory and mobile should be largely offset, and then some, by the cloud side. Jason Child, CFO, Q4 2026 earnings call, May 2026. This phrase is a masterclass in corporate redirection. It is designed to make investors feel that the triple-digit growth in cloud AI renders the crumbling foundation of the smartphone market irrelevant. When a CFO uses the phrase offset and then some, they are attempting to bury a structural volume decline under a temporary price mix improvement. They want you focused on the shiny new Neoverse CSS, compute subsystems, the pre-integrated silicon blueprints for data centers, so you do not calculate the math on the 15 million developers who are seeing their primary hardware target, the smartphone, hit negative unit growth. The lab decodes this differently. While the PR focuses on the cloud AI halo, the insider activity tells the real story of valuation anxiety. Insiders net sold 249,782 shares in the past 90 days. When management tells the public the story is just beginning, but the people with the internal roadmap are hitting the sell button at a 90x forward PE, price-to-earnings ratio, a valuation metric comparing stock price to per-share profits. You have a massive divergence between the script and the conviction. 4% slip in pre-market trading isn't just a random tech sell-off. It is the market finally pricing in the SoftBank overhang. SoftBank still owns roughly 90% of the equity, and their recent move to secure a $10 billion loan backed by OpenAI stakes signals a liquidity requirement that often precedes a secondary offering, the sale of existing shares to the public, which can depress current prices. What management is saying is that the AI transition is seamless. What the lab hears is a desperate pivot to capture higher ASP, average selling price, the dollar amount earned per unit, to compensate for a saturated mobile market that has officially flipped to negative growth. The engineering reality is that ARM is no longer a volume story. It is a royalty rate arbitrage play. The financial engineering here is as complex as the ARM9 architecture, the latest instruction set that dictates how software talks to hardware. ARM delivered an EPS beat of 2.1%, but look at the R&D, research and development, spend. They are burning $2.8 billion, or 56.4% of total revenue, on R&D. That is a 34% increase year over year. In the PR world, this is framed as investing in the future. In the engineering world, this is the cost of staying relevant as risk-V. The open-source hardware instruction set that allows companies to design chips without paying ARM's royalties begins to reach commercial scale in server and automotive applications. Wall Street is currently split in a way that signals a peak. While TD Cowen and UBS aggressively raised price targets to the $470 range in late June, New Street Research moved from buy to neutral. This is the valuation wall. Even with an exceptional 95.3% gross margin, the percentage of revenue exceeding the cost of goods sold, you cannot sustain a 90x multiple if the underlying unit volume is shrinking. Management's language in the Q&A session revealed the stress. When asked about royalty rate growth, Jason Child admitted that the mobile market actually flipped to negative. Compare this to the previous year's tone where mobile was described as a stable foundation. They have stopped calling mobile a growth driver and started calling it a tough comp, a comparison to a prior period that is difficult to beat. This is a classic linguistic shift from offensive to defensive positioning. The lab's verdict on the PR filter: ARM is using the AI PC and sovereign AI narrative to mask the fact that they are an architectural monopoly facing its first real threat of commoditization. Watch for the ARM9 royalty penetration percentage in the next 10Q filing. Currently, it sits at roughly 25% of royalty revenue. If that number does not cross the 30% threshold in the next 90 days, it means the transition from the older ARM8 to the high-royalty ARM9 is stalling. If that penetration rate plateaus, the bull case for margin expansion dies, and the 90x P/E ratio will be repriced with extreme prejudice. The royalty arbitrage is working for now, but the silicon reality is that ARM is running out of new pockets to pick. Wall Street fixates on the mean price target of $297.03, implying a marginal downside, while the lab zeroes in on the RSI at 27.6, flagging a deep oversold condition. The trade lies in the gap. If the RSI rebounds and the price stabilizes above support, ARM can rally despite Street's modest target. But if the RSI remains weak, the downside risk persists. The momentum breakdown for ARM. RSI sits at 27, pointing to oversold territory, potentially setting up a bounce. MACD is currently bearish, with downward histogram pressure. The bull case for ARM rests on the mandatory nature of the ARM9 architecture in the Blackwell GB200 NVL72, NVIDIA's latest liquid-cooled rack-scale AI system. By integrating Grace CPUs, NVIDIA is forcing a massive upgrade cycle that utilizes ARM's Neoverse V2 platform to optimize memory coherency, the synchronization of data across multiple processors. This shift from simple IP licensing to the high-margin CSS, compute subsystems, model allows ARM to capture significantly higher royalty rates per chip, essentially moving them up the value chain from a blueprint provider to a subassembly architect. But here's what breaks the bull thesis: the Qualcomm litigation and the 11.3% short float. The percentage of shares being bet against the stock suggests the market is deeply skeptical of ARM's legal moat. If Qualcomm successfully defends its use of NVIDIA's custom cores without paying the higher ARM9 royalty rates, it sets a precedent that could allow other architectural licensees to bypass ARM's most profitable revenue streams. Furthermore, New Street Research's recent downgrade from buy to neutral signals that institutional conviction is wavering as the stock trades at a staggering 355x trailing PE. The pro-level question that management must answer is this: as hyperscalers like AWS and Google move toward fully custom silicon, what stops them from eventually migrating their internal workloads to a customized RISC-V ISA once the software compiler ecosystem matures in the next 5 years? The lab's answer is that while the software ecosystem currently provides a massive switching cost, the sheer scale of CapEx, capital expenditure, at companies like Microsoft and Meta makes the long-term investment in an open-source, royalty-free architecture an inevitability, not a possibility. ARM is currently in a race to extract maximum value from V9 before the open-source alternative reaches parity. The lab's conditional call is built on the AI score of 60 to 100, reflecting high technical quality but extreme valuation risk. If ARM reports that ARM9 royalty penetration exceeds 35% by the end of Q3 2026, we expect the stock to challenge the $439.46 resistance level as the earnings power of the new architecture finally catches up to the multiple. However, if the Qualcomm litigation results in a stay or a settlement that favors custom silicon flexibility, the stock will likely retreat to the MA200, the 200-day moving average, at $274.70 as the ecosystem royalty moat is officially declared breached. The lab is neutral to bearish at these levels. The engineering is world-class, but the 96.8x forward P/E leaves zero room for the reality of a normalizing macro environment. Here's the macro picture shaping ARM's strict Bureau of Industry and Security export controls on high-performance compute limit the licensing of Neoverse V-Series cores to Chinese hyperscalers like Alibaba and Baidu. Growing geopolitical friction also threatens royalty streams from the ARM-China joint venture as domestic RISC-V alternatives gain traction under state-led self-sufficiency mandates. The rapid shift toward custom silicon for generative AI workloads is driving massive adoption of the ARM9 architecture and Neoverse V2 platforms within AWS Graviton 4 and Google Axion instances. This trend will accelerate as the Blackwell GB200 NVL72 integrates Grace CPUs to optimize energy efficiency and memory coherency in massive liquid-cooled clusters. The primary upside catalyst is the expansion of the high-margin compute subsystem strategy which captures higher royalty rates per chip compared to traditional IP licensing models. Conversely, the biggest downside risk is a slowdown in Windows on ARM laptop shipments if the Snapdragon X Elite fails to gain meaningful market share against x86 rivals. ARM Holdings sits at the apex of the AI infrastructure cycle. The lab sees a company riding a wave of record licensing and royalty revenue, bolstered by aggressive data center adoption and the newly launched ARM AGI CPU, while the market still prices the peak despite a 7.5% pullback. The lab frames this position as a high-growth, high-valuation play that remains fragile in the short term but poised to capitalize on expanding compute demand over the next 2 quarters. ARM is trading like a growth king, but the numbers say it's the slowest horse in the AI semiconductor race, trailing NVIDIA by 65.1 percentage points in revenue growth. Let's start with NVIDIA. They're printing money at 74% gross margins while growing revenue 85.2% year-over-year. ARM's 20.1% growth looks anemic next to that. NVIDIA's edge? They don't just license IP, they ship the entire AI stack, from GPU dies to CUDA software. ARM's architecture is the foundation, but NVIDIA is the house. That's why NVIDIA's PE of 30x is a steal compared to ARM's improved multiple. The market's paying for execution, not potential. Now Intel. Their 70x PE is a joke, until you realize they're the only US foundry with a shot at catching TSMC. ARM's growth is stronger, but Intel's gross margin is cratering at 37%. That's the cost of playing in the fab game. ARM avoids that capital drain, but Intel's edge is control. They can optimize x86 and ARM designs in-house. If Intel's 18A process delivers, ARM's licensing model gets commoditized. Right now, Intel's valuation is a bet on a turnaround. ARM's is a bet on staying relevant. Qualcomm's the wild card. Their revenue shrank 3.5%, but they're still printing 55% gross margins. That's the power of mobile royalties, ARM's core business. Qualcomm's PE of 19.5x is half NVIDIA's and a fraction of ARM's implied premium. The edge? Qualcomm's Snapdragon X Elite is the first real threat to Apple's M series and laptops. If that chip gains traction, ARM's architecture wins, but Qualcomm collects the royalties. ARM's growth is higher, but Qualcomm's margins prove the licensing model is still the cash cow. Valuation check. ARM's PE is missing because they're not profitable on a GAAP basis. That's a red flag. NVIDIA trades at 30x earnings with 85% growth. Qualcomm trades at 19.5x with negative growth. ARM's implied multiple is sky high, but the growth doesn't justify it. The market's pricing in AI hype, not fundamentals. Capital efficiency? NVIDIA's 74% gross margins and 85% growth make them the clear winner. Qualcomm's margins are strong, but growth is flat. Intel's margins are weak, but their turnaround could redefine the sector. ARM's 20% growth is solid, but not elite, and their margins aren't disclosed, which means they're likely lower than NVIDIA's. Bottom line, ARM stock is a bet on narrative, not numbers. NVIDIA's the safer growth play, Qualcomm's the cash flow king, and Intel's the high-risk, high-reward turnaround. ARM's current price only makes sense if you believe they'll outgrow NVIDIA in AI, and the data says that's a fantasy. ARM's 6nm V9 die shrink just hit 92% yield in TSMC's Fab 18. That's the signal. Is ARM a buy and hold or a trade? Comment your time horizon below. This isn't financial advice, it's engineering context. Markets change, yields shift, and past performance never guarantees future returns. Always run your own numbers and risk models before pulling the trigger. Hit subscribe if you want die-level data before Wall Street gets it. If you want our full breakdown on AMD, the link is in the description. We'll see you in the next lab.